People don't dive into the data. They're listening to headline news, mainstream one-liners. You can't always believe what you're hearing in the news or from our officials.
The Fed chair is never going to tell you he's worried. He's never going to say, you know what, I'm actually really afraid a recession's coming. And yeah, I made this 50 basis point cut in hopes that we get in front of that. But gosh, I don't know. That would create a recession overnight. Policy outcome has been to reward those who own the assets to the detriment of those who don't. They get stuck with the rise of cost of living. Part of the story, if we really want to see change, is going to be us, the populace, demanding the reforms that we want to see of our elected officials and really holding them accountable. We've come to believe that this is just the way that it is, rather than what the truth is it's a deformation of the system. And you can only deform a system for so long before it has to try to get back to equilibrium. And there is going to be a lot of losses during that process. We could be seeing a recipe for pain coming up here. This is a movie we've seen before, and if it plays out the way that it has in history, probably not going to end well.
Finance expert Adam Taggart says there's about 100 million working-aged Americans who have escaped the workforce. He says many of which are playing video games in their parents' basements, fighting addictions and mental health problems. And many are living off of government entitlements that's not really making this societal issue any better. I personally believe that a lot of people they don't want the jobs that are available, because even then, if they go to work, they still won't make enough money to survive. Adam also says that there are a lot of signs, red flags, that the U.S. economy is in for some economic pain. And now we have the Federal Reserve panic-cutting rates, indicating the potential for higher unemployment. But folks, there is light at the end of the tunnel for those seeking opportunities, and Adam shares his advice and more in this interview that you're about to hear. I hope you enjoy the show. All right, Adam, thank you so much for joining me again today.
Oh, it's always such a pleasure, Todd. Thanks so much for inviting me back.
You bet. Our audience loves when you're on. And as I had said before, you spend so much of your time interviewing other people. It's an honor for me and a pleasure to actually turn the table around and interview you, Adam. So just for the record, because a lot of people may not know who you are, and they also may have never seen our podcast together. So kind of just give everybody the overview of, who is Adam Taggart, how you became where you are today, and why you focus so much on finance. Sure.
And I think I've given you the longer answer before, so I'll try to give just the cliff notes here. I'm a regular person, just like the folks watching here. Essentially, I created my channel, Thoughtful Money, because it was sort of the channel that I, as just a regular investor, wanted to see in the world to help make me smarter and better informed about how to build wealth. And my journey to this, a bit of a circuitous one, but the highlights are, I did fairly well academically, ended up going to an Ivy League undergrad. I got my MBA from Stanford. But nowhere in there was I ever given really a single class on just sort of practical financial literacy. Just like the basics, like, hey, you're going to have to buy a mortgage. This is how a mortgage works. Or, hey, here are the principles of sound investing. Our education system, as we've talked a lot about in the past, Todd, just, I think kind of gets an F grade in terms of teaching financial literacy, which is, it's just so mind-boggling, because that when you talk to people, that's the whole reason why we go get educated, right? Is we think it's going to help us have an advantage in life. And when you ask, well, what do you mean by having an advantage? People basically say, well, I'll probably earn more money and be able to do more things as a result. But it actually doesn't teaching us the how to earn money part and how to build wealth over time part. It just sort of magically assumes the clouds will part and we'll have had some epiphany along the journey. So, I had all that education, all that academic education, but not any practical education. I then went right out of undergrad to go work on Wall Street in one of those investment banking analyst programs, and got a front row seat as to how Wall Street exists to serve itself and the interests of its clients are basically dead last on its priority list. The culture was not a good fit for me, so I got out of there pretty quickly after 3 years, and then went and got my MBA at Stanford. And that's when the internet revolution happened, and I saw the massive power of this new medium to help bring really high quality information to many people at very low cost or even free. And I ended up deciding to combine those two interests from my experience base, which is, I now kind of had a good sense of how the economy and the financial markets worked, a realization they didn't work for the interests of the regular person, and the education system was just making that worse by, again, not teaching people the fundamentals. And then pairing that with this new internet medium, I wanted to basically democratize financial literacy and try to bring this information to as many people as possible for as costless a price as possible. Founded a couple companies along the way to help me do that. I worked at Yahoo for about 10 years too, starting off there as the head of marketing for Yahoo Finance. So took all of this experience and this mission, and then eventually founded Thoughtful Money. And folks, if you haven't watched Thoughtful Money, it's not too dissimilar from this channel of Todd's, where we do deep dive interviews with top experts in money in the markets. I like to think of it as sort of like a 60 minutes for money, if you will. And I think that's about as short as I can make it.
Yeah, well, you talked about education and it really failing us as far as, or at least the concept that, you go to a university to get a more formal education. And a lot of people think that turns into dollars. There were many years ago, 25, 30 years ago, I went to a live conference to see a guy speak named Jim Rohn. I don't know if you remember that name, but
I'm very familiar with Jim Rohn.
He was a self-help kind of, motivational type of seminar. And he said that formal education will get you a job. It's self-education that actually makes you a fortune and sort of, prepares you for what is failed in our educational system. So it's great. Certainly your links to your YouTube channel are in the show notes for anybody. I highly recommend you go over, subscribe to Adam, and everywhere he goes, whether it's his Substack or X, we'll post all the links below. Right. I want to dive into two main things with you today, Adam. One is, actually both of them have a dramatic impact on American people. One of which is our jobs market, as it pertains to unemployment, people either having a job or not having a job. And number two, the ability, as in what you were speaking to, for Americans to earn enough at their job to afford life's necessities like a home, groceries, their ability to raise a family if they want to have kids, and I'm talking about above poverty levels here, and to be able to afford a vacation now and then really what goes along with that is the ability to save money along the way to hopefully invest in their future, like retirement, for example, but really having extra cash after life's essentials that they could either have in a bank or in an investment that outperforms inflation. And we know that has been almost impossible. So how's that sound if we talk about that?
Those are all near and dear to my heart. So let's dive right in.
So the real question is, do the people running our country and making the decisions for our economy have that ability to make this opportunity happen? Or I guess, Adam, the bigger question is, do they even want this for the American people?
Yeah. Wow. We're going to depress a lot of people right from the start of this discussion, huh, Todd? I get a lot of comments on my channel of people who are like, don't you understand this is all going according to plan? There's this big giant conspiracy, this cabal at the top that's running the world, and their intent is to, basically enslave all of us over time, right? And I don't put a lot of stock into a grand conspiracy like that. But I think we almost sort of have the same system where it's just a bunch of self-interested players who have gained advantage in the system one way or another, and then they have reinvested that advantage to continue to protect their interests. And over time, that has led to corporate cartels. So it's pretty hard to find an industry now that essentially isn't run like a cartel, where there's a few big companies at the top, and then they lobby and fund all sorts of regulations and stuff like that that increase the moat, that make it harder for competition to dislodge them. And I think the people that go into politics, the way that the political system has sort of metastasized over time is your worth as a politician is your ability to raise money for your party. And what that does is it slowly compromises people's priorities, and it creates bad incentives, and it essentially creates a political class that is captured by these money interests over time. So that's sort of the context at which I look at the political system here. So I think the ability of a bright, shiny, newly elected representative to come in and conduct policy the way that they think it should ideally be done immediately kind of runs into that meat grinder of all those specialized interests, right? And I'm pretty convinced that there's some percentage of there's probably a higher percentage of sociopaths in politics, just because it sort of rewards those traits. But I'm not saying everybody that goes into politics starts off as a sociopath. But I think that the structure of the system pretty quickly strips them of their ideals. And if they want to stay in power, they want to stay in the game, they have to start making all sorts of compromises that largely keeps the status quo lurching forward at whatever cost it needs to continue. And so, I just don't see a lot of opportunity for the types of reforms that you and I think need to be enacted to protect the rights of regular everyday people. And I certainly don't see, reforms being enacted to improve the situation, improve the prospects of regular everyday people, until I am optimistic long term. Until the system kind of breaks under its own impurities, and we get to some painful moment where everybody is sort of forced to look at the system and say, look, there's got to be a better way to do this. And it's at those moments, usually, where history gives us a leader that can push through, the type of reforms that we need, where finally there's enough support on both ends to make that happen. But honestly, I think we're probably going to have to experience a lot more pain. So I think the beatings are going to continue for a lot longer until morale starts improving.
I think one of the issues that really complicates things is that we've become such a global economy. We're not just looking at what's happening here in the U.S. Everything's tied together. And I think that in many ways, that has been very destructive. And when you start focusing about what other people need or care, and I'm not being insensitive and saying that we shouldn't, think about the needs of others on a global level. I'm not saying that, one person should be valued more than another. But I think when we have a body, the American people, that feel like in many ways the worst second string, that a lot of the policies and a lot of the things are benefiting people that are living in other countries instead of focusing on our own problems and issues, that's where a lot of the contention lies. At least what I see and hear and think about myself is, well, why are we worrying about that when we're not doing more for our own people? And I think that gets back to the opening, on what we're going to go over, is us being able to live in a financial time. I mean, I can remember, and you and I are around the same age, but I can remember starting out as a business person in my early 20s and where I was making money on my savings, where I could afford to do things. And, and when we look at housing, where we could afford a house from one, paycheck, and it was perfect. I mean, it was adequate. Yeah, we had other problems and issues. You always do, societal, issues. But one thing was certain: we didn't see the wealth divide like we see now. We didn't see the homelessness that we see now, and certainly the people that are living on poverty. And it's almost like that is part of the plan. I mean, I'm not saying that it is, but it's, when you start to provide or prop people up, people become dependent on that. And when you're not, triumphing success, and you're not rewarding people that do things that are good, they start to give up and say, well, you know what? It doesn't matter. The better I do, the more money they take, and I'm in even the same position. You interview a lot of people, and I want to talk about the Fed's recent decision to change policy and cut interest rates and what that may or may not mean. But before we do that, I just want to ask you, because I follow your channel and you interview a lot of you have stellar guests that just bring so much to the table on both sides, really, all sides. And, their opinions on what they think will happen in the stock market, where a lot of people, look, there are a lot of people that are dependent upon the stock market for their retirement, in one way or another. Is there anybody that you've interviewed lately that, that has said things that you could share that have really kind of put concerns or worries in the back of your mind?
Yeah, the list could be quite long. Also, Todd, I will answer that question. I just want to note that in leading up to it, you mentioned like 5 or 6 things that we should probably also dig into. But let me address your question first. Yeah, it's actually kind of hard to just pick 1 or 2. I do 4 interviews a week, and it's been a really good run recently. A lot of really good interviews, but some that stick out in my mind are one is a fellow named Jam Carson, who folks might know him from his Twitter handle, Jam Croissant. But he runs a volatility focused fund, and he understands volatility better than practically anybody I've ever talked to. And he basically explains how if you've heard of what volatility is in the markets, but you're not quite sure what it is or how it's measured or what role it plays, highly recommend you watch that video. But the crib notes are that Jem basically says low periods of volatility create spikes in volatility, where it's almost like a spring. Like the more you compress the spring, the tighter it gets coiled, the more likely it is it's going to sort of snap at some point, right? And he thinks we're coming off a period of very low volatility, and that going through the end of this year into next year, he expects volatility to continue to rise. And the reasons, sort of what he puts forth to explain why, are actually pretty fascinating. It doesn't necessarily mean prices are going to go down, and people generally think volatility equates to lower prices. It really doesn't. But he thinks that, in fact, we may see a bit of a market run-up heading into the end of the year, maybe even really spiking at the end of the year. But then he thinks the chickens are going to come home to roost, and we're going to continue to have even more volatility, but it's going to be kind of the destructive kind. And I'll pair that with an interview that I just released the other day with Ted Oakley from Oxbow Advisors. Ted has had a very long career in the markets. He does a very good job of just sort of explaining market trends in regular person speak. And Ted is quite worried about the level of complacency that we see in the markets right now. And complacency is sort of the main food source for bear markets. And Ted has seen a lot of bear markets in his career, and is basically beginning to see the indicators that we could be, to use his words, seeing a recipe for pain coming up here, where kind of like the Roach Motel, let's say Jim Carson's right and the markets continue running up and then maybe really have a big blow-off spike at the end of the year. That attracts a lot of investors in, and at the end of something like that, it really attracts in the most novice investors who start, getting caught up in the FOMO, right? And they start taking risks that maybe they can't afford to take, but man, everybody's doing this and everybody's getting rich right now. If that indeed, ends up being the moment where the rug does get pulled, the damage, and that's really the job of a bull market, is to suck as many people into it as possible. The job of a bear market is to then surprise them maximally and wreak as much damage as it can. And time will tell if he's right or if he's wrong. But Ted is just having seen this set of conditions many times before. He says, this is a movie we've seen before, and if it plays out the way that it has in history, probably not going to end well. I'll add one last factor into the mix. I had a really interesting discussion with Jesse Felder, and Jesse has a ton of indicators that he tracks, and you have to. There's no one magic indicator out there that it'd be wonderful we could just navigate by one set of data, but that's not the way the world works. But he said if he were sort of trapped in a desert island and could only look at one indicator to understand where the market's headed, it would be the 12-month corporate insider sell to buy ratio. And basically, corporate insiders sell more when they are more nervous about the future prospects for their companies. That is up at near an all-time extreme. I think the last time in the data series it was this high was in 2021. And what happened, the next 12 to 18 months after that? We had a big earnings recession, and the markets had a horrible year in 2022, right? So he's basically saying, if you look at that data point, which is has a near perfect track record, he just says, the current earning estimates that the street has for 2025 are far too rosy. And again, when the insiders are selling, that's not an opinion, that's an action. They are literally taking their chips off the table because they think those chips are going to be worth a lot less going forward. So hopefully I answered your question there, gave people a couple of different names and videos to go check out. But it is not hard to find people who are concerned about the current level of market valuation.
Yeah, can you just explain the volatility aspect that you started off with?
Sure. Well, so volatility is just basically a measurement of change, right? So when the markets, become more volatile, just think about like an airplane, turbulence, right? Start going up and down, right? And volatile markets tend to be more challenging for investors because prices are changing all the time, up, down. You feel a lot less certain. And in general, I'd say more often than not, more volatility, more uncertainty makes people more nervous and they sell. And so prices tend to come down in times of higher volatility. Again, not always the case, but more often than not. I think it's important to know that volatility in general, we have become so used to volatility really being dormant. When you think about what's happened since the great financial crisis, with all of the intervention from the central planners, all of the liquidity that's been put in the system on the monetary side, on the fiscal side, all the QE programs that the Fed was doing since 2009, where they're out there just supporting assets by being in the market, buying them month after month after month at big volume, that kept volatility really quiescent. And so I don't know if your viewers are familiar with the book The Hobbit or the movies about The Hobbit, right? There was the dragon Smaug, right, who basically was sleeping forever, and then he sort of gets woken up and then does a ton of damage when he gets woken up. That's kind of what a return to volatility can be like. It's like Smaug the dragon getting awakened, right? And Jam and a number of other folks that I've interviewed have said, volatility is likely going to be higher going forward. Just like some people think we're going to be entering into a secular era where inflation is going to be higher going forward than it was in the past. Hopefully it's not going to go back up to 9% again, but maybe it's going to ping pong between 3 and 4% for the next couple of years. There's a lot of analysts out there who think just volatility is just going to be higher. And in that type of regime, it requires a different investing playbook than the one that we've all become so used to, where it was basically just buy the market, buy a sector ETF, just ride it and buy every dip because the trend is just always going to be up and to the right. It's going to be much more probably like this going forward. And what's interesting is you can actually make a pretty good deal of money, pretty good returns in a volatile market, but you have to have a very different playbook. You can't be a passive investor the way that you were before. You have to be a much more active investor where you're staying on top of the markets. You're doing the math all the time about valuations and looking at the technical charts and saying, okay, this week's a good time to be more on the sidelines. Okay, now that conditions have come down, they're not overbought anymore. They're oversold. Now the probabilities to the upside are higher. I'm going to go back in. And the reality, Todd, is just that a lot of people don't have that experience because they haven't had it for a couple decades.
It's when they lose.
Yeah, exactly.
It's when their inexperience becomes disastrous.
Exactly. And I'm sure we'll talk about this later, but this is why, like on my channel, I just constantly beat the drum that unless you have a really good, successful track record yourself of being a DIY investor and growing your wealth in good times and bad, most people would benefit from working under the guidance of a good financial professional who has that experience. Now, there are some great DIY investors out there that have those skills, and they should be their own financial quarterbacks. And there are a lot of financial professionals out there, honestly, who don't have this type of experience because, as I said, they haven't had to really exercise those muscles. So I generally recommend that people look for a firm that's been been out there in operation for decades and has some experience with the GFC, with the dot-com bust. Most of the folks that saw the action back in the 80s have pretty much retired at this point in time, but at least somebody that has studied that period and knows, what the data suggests should be done. Because I think going forward, the next decade or so of investing is going to look a lot different than the past 20 years.
You had mentioned that there were some things you wanted to unpack before we got into, the interviews that you've conducted. Do you want to touch on those now?
Yeah, I'll hit those quickly. And again, we will get back to the question you asked, which is a really important one, which is, hey, the Fed just pivoted, right? It's been talking about it forever. It finally just did. In fact, it did a 50 basis point cut. What's the significance of that? So I want to make sure we get to that because I'm sure people want to hear the answer to that. But real quick, you were talking about just sort of, a country that prioritizes people who live outside the country more than it prioritizes the people that live inside it. That obviously doesn't seem to be a very good strategy. I would agree with you. I would say, I just wanted to highlight some of the things that make it an interesting discussion because I agree with you. But part of the story, if we really want to see change, is going to be us, the populace, demanding the reforms that we want to see of our elected officials and really holding them accountable. And I don't think we've really reached that state yet. Again, I think eventually we probably will when things start breaking badly enough. But to a certain extent, we get the governance that we deserve. And right now we are not holding their feet to the fire, my opinion, as much as we should. And, that's why you can see you didn't mention it, but I'll use it as an example. A lot of people have issues with the amount of money that we're sending to support the war in Ukraine, right? Half a world away. Is it really our business to be sending that much of our treasure there? And obviously, some people are going to say, "Well, look, that's the battle line of democracy, and we've got to hold Russia there and whatnot." And people can debate whether that's true or not. But an economic reality there is a huge employer in the U.S. economy is the military-industrial complex, right? And basically, the rationale inside Washington is, hey, to support all these American jobs, we got to be making munitions and stuff that we're sending, to hotspots like Ukraine, right? So there's an economic interest in, one can argue for America there. And we as a people have to say, well, all right, because the pushback will be, what do you want? You want layoffs in the military industrial complex industry? That's a lot of people we could be laying off. And we as a populace, I think, have to say, yeah, we'll be okay with that. We're willing to take that trade-off to keep the capital here in the U.S. and be spent in ways that are going to benefit us more directly, right? Similarly, you and I have talked a lot about this, so I'll just mention it, but immigration. We've talked a lot about how we have kind of a nonsensical immigration policy right now, at least particularly as it comes to illegal immigrants coming into the country, right? And I think both you and I feel that the country would be much better served by some sort of focused policy, right? It makes sense for us to bring in a certain number of immigrants. We want these type of skill sets, and then we'll reserve some percentage for amnesty, right? But we'll manage to that, right? And as I've heard recently said, you want high walls and open gates, right? So you want to be able to protect people getting in illegally, but you want to let as many people in as makes sense, right? We also have to be wide-eyed and say, look, the economic model that we have right now in America depends upon basically an ever-growing number of people in that core working class demographic of 25 to 54-year-olds. And that population is actually shrinking right now. And if you look at, and there's several reasons for that, but long story short is just birth rates are down. And they're down because largely Americans don't feel like they can afford to have as many kids as they did in the past, right? And so if you want the existing model to continue, we either have to dramatically goose American birth rates, which is possible, but will take a long time, or we need to import immigrants to fill the hole, right? And so where I'm going with this is just we have to have an eyes wide open decision about what we want, right? It's nuanced, it's complicated. We need to be really clear about priorities and then let the debate drive the decision making. And of course, we're not even having those discussions right now. And the different, special interests that I mentioned earlier, they're just driving the show with no real pushback or oversight from their colleagues. In many cases, they're paid lackeys in politics. And again, if we as the populace are just sort of asleep at the wheel and letting that happen, to a certain extent, that's on us. So we need to get more engaged. One other really important factor on this too, I feel I got to note is that, we have an underemployment crisis here in America. And it's funny saying that when the unemployment rate is still, 4.2%, or right? I mean, whatever number it's currently at, it's been rising, but that's still a historically very low number. But you've got to take into account how they calculate it, right? So there's over 100 million U.S. adults, working age adults, U.S. adults, that are considered not in the labor force, right? Now, some of these people are retired and they're too old to work. Some are college students. Some are disabled. But a large and fast-growing percentage are people that are literally just checking out. They're getting demoralized, and they're just saying, you know what? I can probably get a check from the government through some program, or I can get family members to support me. And I'm just not looking. This is kind of the 30-year-old adult in the parents' basement syndrome. There's been a lot of work, a lot of research done on this. If you're interested in learning more about it, there's a really fascinating interview I did with a guy called Nick Eberstadt, who wrote the book Men Without Work. I think about close to 10 years ago. He's now updated his research, and it's now increasingly men and women who are falling into this category. So my point is we have a very underemployed amount of able-bodied citizens in this country who have basically checked out. And before we make the argument of, let's bring in a bunch of laborers illegally into this country because no American will do the work that they'll do. It's like, well, wait a minute. We got millions of people here who are not contributing. The research shows these people are depressed, oftentimes, addicted to painkillers and other drugs. They're not living their best lives. Let's put it that way. They don't have a sense of purpose. They're not productive members of society. How can we address what's going wrong there and reactivate that labor productively in here before we start bringing in a bunch of labor that we haven't planned for, how we're going to support, through social systems or a path to citizenship or whatever, right? So there's a lot of different factors that are going on here where, again, I think we're dropping the ball because of bad or misguided policies or lack of a real plan here. And like I said, I'm kind of a fan of the high walls, but wide gates, as long as we have a really, smart policy for how many people do we need to bring in? How can we reactivate the dormant talent we have here? What's the gap between where we want to grow the economy and how many additional workers we need? Okay, great. Let's get that number. Let's figure out what skills we want of that base. Great. Let's recruit for them. And then, yes, let's have some percentage for the amnesty hard luck cases that America has always been, respected around the world for bringing in those people for.
Adam, a lot of what you're talking about right now really comes down to the local elected officials. I mean, who would or should know more about the population that is in the most need than them? And what do you suggest for something like that? I mean, obviously, this gets back to resources. I think in a lot of ways our welfare system is broken. I think in a lot of ways it's abused. Should people be on welfare for 25 years? I mean, I'm not judging anybody. I think welfare is great for its purpose. It should be, we should have resources on a community level for people, but it seems like the ones that need it really bad now, they have to wait 20 or 25 years to be eligible. And, so our resources are kind of out of whack. What would you recommend for this, million plus workforce that you're describing that's in mom or dad's basement, depressed and really needing somebody they need help?
Yeah, that's a great question. And I'll be super transparent here. We're beginning to move out of, my day-to-day focus on, where the markets are headed. So I'm not a policy expert, but I sure have opinions here. Look, I'm all for social support programs that give people a helping hand during, a time of crisis. But they have to be limited, and they have to provide a pathway, or they're better served by providing a pathway back to productive work and getting off of the entitlements. Because I think that the history is pretty clear that, basically if you provide permanent entitlements, you end up creating dependency, and dependency that then gets learned over generations. Right. And that doesn't serve anybody's interests. Right. You go from something that started with a noble intent that actually has an outcome that's completely the opposite of what you were hoping to achieve. Right. So, obviously, I know the cynics, and trust me, I'm largely one of them, who say, look, these programs are largely used for political aims, to keep certain parties voting certain ways and things like that. I don't doubt that at all. But like I said, I think, that's one of the great benefits of a wealthy society like ours is we can have a little bit of a safety cushion for, those that end up on the losing side of capitalism, right? Capitalism is always going to have winners and losers. You just want something that can kind of get them back in the game as quickly as possible here, right? So, I mean, there's a lot of things. Certainly, one example of a policy is disability insurance. It is getting increasingly abused, and largely by people that are either getting put on disability for mental health conditions. And I'm not talking down mental health at all. And just a reminder to folks who don't know, my wife is a therapist, so it's something I actually have a lot of respect for, and I'm glad that our medical system is increasingly supporting mental health services. But it can be this kind of inscrutable shield that people will use as a reason that they can't work, right? And it's a very difficult condition to prove or not, right? Similarly, people will claim something like, "Well, I got back pain, right? And I can't work," right? Again, that's something that's notoriously hard for doctors to diagnose, and be able to tell if somebody is telling the truth or lying here, right? And so people have learned how to game the system, where they're able to get on, disability and basically collect a check from the government that gives them enough of an ability to feed themselves and attend to kind of the basic needs of their lives, where they can kind of check out and play video games or do drugs. And again, I'm not vilifying people that are on disability in general. I'm just sharing ways in which that particular system has been taken advantage of, and that certainly a lot of opportunity for reform there as well. But I think, in general, it's generally a system of sticks and carrots, right? If you are taking benefits, well, they have an expiration date on them, and you have to prove over time that you are out there getting work to be able to continue to get them in some intermediate period. And then after some point, it's just say, sorry, we gave you what you needed. It's time to leave the nest and fly. At this point, people watching this are probably giving even better policy ideas in the comments here. But again, it all just comes down to what are the goals that we want to achieve, right? What are our priorities? Fantastic. Once we have those, we can start aligning incentives to them, and then the game plan kind of just falls out of that. And capitalism is a system that once it knows the rules, it'll come up with great solutions. We just have to be really clear and consistent about where the borders of the playing field are and what the rules of the game are. And in many cases, we don't even need the government in these spaces. Capitalist-driven solutions will start filling this hole in many ways, the way that they were filled by entrepreneurs, by philanthropists before, the FDR era or the Lyndon Johnson era.
Well, let's talk about some of those things, whether we can get back to that level of capitalism or not, because it seems like they're making capitalism the enemy in a lot of different ways. Let's talk about the Federal Reserve, the United States Central Bank, right? And I mean, there are other central banks, obviously, in every country has a central bank. But to begin with, for those watching who don't know what a central bank is, can you provide a brief explanation?
Sure. Generally, their role is monetary policy. So basically, they're in charge of the money supply and the cost of money, if you will. And so they set the federal funds rate, which basically determines how the price at which money is loaned out in the system. So in an economy like ours, where credit is kind of the lifeblood of how the economy runs, their job is basically to make sure the system runs smoothly, and they do that largely by either easing, which is putting more money into the system, more liquidity in the system, or tightening, which is taking it out. And the tools they use to do that usually involve making money more or less expensive to lend. And if it becomes more expensive to lend, less money gets put out there, and that's called tightening, right? That contributes to the tightening policy. So, anyways, we have had central banks around the world that have they were originally created to be a lender of last resort. So, like if we go back to the Great Depression, when hard times arrive and the players in the system start not having confidence in the other players in the system. Like if I loan you money, Todd, if I'm all of a sudden nervous that you're not going to pay me back, well, I might stop lending you money, right? And you might still be a good, maybe you would have paid me back, but I just don't know. And that transaction that we would have done doesn't get done, right? So that's what happened at a very large scale back during the Great Depression. And crises before then, because we did have a Federal Reserve leading up to the Great Depression. But during those crises, liquidity would just dry up, and banks would stop lending to people, to businesses, to each other, and the economy would kind of grind to a halt, right? So central banks were basically created to be what was called the lender of last resort. Hey, everybody gets unfairly hurt when the gears of the economy seize like that. So we want to have some institution that will step in and provide liquidity. We'll be that lender when nobody else wants to be. So the system still works, and it doesn't just seize up and then companies have to fire everybody. Then we go into this massive unemployment down spiral. But over time, you give that type of power to an institution, it starts finding more and more ways to use it. And so central banks have become more and more what I would call interventionary, which is they start tinkering in the economy when it's not a crisis, when it's not the last resort. And then over time, people become used to that tinkering, and then they want more of it, right? And that's kind of how the system has metastasized as time has gone on here. So that's why we have central banks, and I think that's why we're at an era right now where the world is so transfixed by what the central banks are going to do, because rather than just being the backstop of the system, they're basically now the conductor of the train, and everybody's wondering what Fed policy is going to be because they think that that's going to determine where the train goes from here.
And the United States Federal Reserve System is the world's largest central bank. It has more than $7 trillion in assets, and by the way, valued in U.S. dollars. And second is the People's Bank of China, being, like I said, number two at $6 trillion in assets. How significant is the Federal Reserve's recent decision to cut interest rates? And what do you believe this means for a global economy?
Okay. Well, all right. I think it's probably welcome news to the global economy. The U.S. economy has been the best of the bunch for the past several years. It's really been the engine that's been pulling the rest of the world along with it. China had been a really big driver of the global economy, especially after the global financial crisis. It really helped pull us out of the global financial crisis. And coming into this year, people were hoping that the Chinese economy was going to start really growing again, and that we'd get some help. We get another lead horse up here helping us pull the global economy. That's not materialized. China is really kind of in a world of hurt right now and is growing much less than the world expected. And all economies around the globe right now are growing generally less than their historic averages. And there's a general concern about the strength of continued economic growth globally. So I think folks thinking, okay, well, the Fed has now stopped its hiking regime. It's now starting to ease again, and it started with a bang. That's going to be stimulative to the U.S. economy, which will be stimulative to the global economy. And there's a lot of other policies that get set around the world based upon what the U.S.'s Federal Reserve federal funds rate is. I think people who like the status quo are breathing a bit of a sigh of relief that, okay, good, Fed's now back to easing, and hopefully that's going to start, goosing economic growth from here. Now, that being said, to the average person watching this, I would say a couple of things about the shift that the Fed has just made. And again, the Fed usually cuts or moves interest rates in what are called basis points. And a basis point is just, it's a 1/100th of a point. So a percentage is 100 basis points. And usually the Fed moves in 25 basis point increments. It surprised a lot of people by going, cutting rates by 50% right here out of the gate. The market was actually, the week prior, finally started actually expecting the Fed might go 50. So it wasn't a shock to markets per se. But if you look at history, that's a pretty big rate cut. And the times where the Fed usually steps in with a rate cut of that size is when there's an unfolding crisis. So, it definitely asks the question, well, wait a minute here. Is the Fed nervous about something? And we'll talk about that in just a minute. But first off, you got to understand that monetary policy, when the Fed pulls a lever, it acts with a lag, and that lag is pretty substantial. So if the Fed, makes the cost of credit more or less expensive by changing the federal funds rate, the benefits of that or the impact of that usually takes quarters. Usually like a year or more to make its way fully into the economy, where you can see the impact of that change head. So it's not like the economy is going to start, leaping tomorrow because the Fed just cut 50 basis points. So it's my first message to people would be, hey, just slow your roll on this right now. It's not like, the economy is going to be totally different tomorrow because of this. It's going to take a fair amount of time. And on that point, and Todd, you and I have talked about this in the past, the Fed hiked interest rates at a more aggressive pace than I think it's ever done pretty much in living history when it started its hiking regime. It then held them above 5% for, basically a year and a half or so, much longer than the market thought it would. That hiking of rates and then holding them at these high levels, that has its own lag effects, right? And now we're beginning to feel it, right? That's why the economy, has been slowing. That's why the employment data has been getting worse. That's obviously why inflation's been coming down, right? So we are still feeling the lag effects from that, and we will continue to feel the lag effects of that for some time from here, likely 12 to 18 months still going forward from here. So we're likely to feel much more of the downward pull of the hikes that have already been done for the next year plus than we're going to see any impact from the cutting that the Fed is starting now. So number one, I'd say, hey, slow your roll. Number two, I would say, yeah, we really should be asking ourselves, is this a move of confidence on the Fed's part or fear? Now, if you listen to the Fed chair, Jerome Powell, he'll say, oh, no, this is all confidence, baby. Like, he did everything but deliver a mission accomplished message when he gave his press conference last week. In fact, near the end, because of some questions he was asked, he had to say, well, wait a minute, I'm not declaring mission accomplished. I want to see some continued data like we're seeing now. But he's basically saying it's kind of all over at this point. We got it. This is done and dusted, right? But those who watch more closely, and understand too, like the Fed chair is never going to tell you he's worried, right? He's never going to say, and I'm actually really afraid a recession's coming. And yeah, I made this 50 basis point cut in hopes that we get in front of that. But gosh, I don't know, right? That would create a recession overnight, right? Everybody would change their behavior. Oh my God, the Fed's worried. The Fed thinks a recession's coming. They would start getting a lot more conservative, and then that would slow economic growth. And then it would become a fait accompli, right? So you got to consider the messenger here, right? There's things that the Fed chair is just not going to tell you, right? But if we look at things like what has changed since pre-cut, now post-cut, the labor market's gotten an awful lot weaker, right? So we had a revision in the payrolls numbers where basically they came out and said, the numbers the government has been publishing through the Bureau of Labor Statistics, the BLS, we're realizing that those were overstated by like over 800,000 jobs in 2023, which is a very substantial percentage of the payrolls that were being reported. Now, Todd, guys like you and I have been talking for pretty much the past 2 years about how increasingly unbelievable the BLS data was. But the authorities were saying, no, that's the data, and it's the jobs data that the Federal Reserve was basing policy on. All of a sudden, it's finally being admitted, you know what? We were using data that was pretty darn faulty. I also want to note too, if you look at some private data, so Challenger, Gray, and Christmas, which is they're a widely respected firm for tracking the labor market, they show that layoffs soared in August, hitting their highest total in 15 years, while year-to-date hiring hit the lowest in 19 years, right? So we've got soaring layoffs, and we've got shrinking hiring, right? So these are signs of not a strong labor market, right? Even though that's what we've been told for basically the past 2 years straight, is that the labor market was kind of on fire, and there were way more applicants way more jobs than there were applicants. Now we're all of a sudden really beginning to see that is highly likely not the case, and I think the data is finally catching up with the anecdotal data that you and I have talked about previously, Todd. Where people who do get laid off or looking to switch are finding it actually quite hard in a lot of industries to find a job now. Not all of them; some are still hiring, but for a lot of industries, especially like out in tech, where I live out in the California Bay Area, it's quite difficult these days to find a new job. So the other thing I just want to note real quickly too, and I'll see if I can share this while we're talking, is the unemployment rate. So Todd, I think we've talked about this in the past, but I was actually really interested that one of the journalists at the Fed press conference actually asked Powell about this specifically, which I was like, this is great. This is a question I would have asked. So the unemployment rate, if you look at it, following just about every recession we've had, the unemployment rate comes down. It then gets real quiet. And then all of a sudden, once it starts turning up, it spikes. Now, we shouldn't look at 2020 because that's what happened then. But 2020 was a pandemic. It wasn't sparked by economic issues. But pretty much every other recession you'll see coming out of it, The rate goes down, it gets real quiet. Once it starts turning up, bang, it shoots the moon. And it happened great financial crisis. It happened in the dot-com bust. It happened in the early 90s. Happened in the early to mid 80s, and back and back and back. And so that's the pattern of how the unemployment rate tends to react. Well, you'll see here now, the unemployment rate has come down since the COVID crisis, bottomed out, and then now it's starting to rise back up here. Even looks like it's kind of gaining steam a bit. So you basically have to have an answer for why it's different this time, why it's going to be different this time. And when they asked Powell about that directly, he actually didn't really have a good answer. He just sort of said, hey, we're going to be on top of this thing. But, if the pattern of history shows that, every time that the unemployment rate comes out of the bottom and starts raising, it really spikes from there. If you don't think that's going to happen this time, you better have a really compelling reason why, because you're basically fighting history on this. And then lastly, history shows that the Fed is generally always behind the curve. Listen to Powell. He kept saying, nope, we don't feel like we're behind anything here. But of course, that's what he's going to say. But if you look at interest rates, and maybe let me see if I can pull that up here for your listeners too, Todd. So you'll see here that in past interest rate hike regimes, the Fed would hike. They'd then plateau, and then they'd start cutting, and very quickly a recession would ensue. We saw that leading into COVID. We saw that leading into the great financial crisis. We saw that leading in the dot-com crisis, and so on in previous decades. And you'll see here the Fed hangs out at this plateau, and then it starts to cut, and then it realizes, oh my gosh, you know what? We must have held rates too high for too long. The economy is heading into recession. That's what these gray areas on the chart signify. And then the Fed is panic cutting, trying to stimulate the economy as the recession's starting to rage. And of course, all that Fed policy acts with a lag. So it's not for a couple quarters before the economy starts responding to the stimulus and starts growing again, and then finally, gets us out of recession. So again, this is the pattern, and here we are again. We hiked rates really aggressively in 2022. We've then plateaued them. We've just made the first rate cut. History shows here that the pattern is that we then go into recession pretty soon after, and then the Fed gets in a panic and starts panic cutting again. Will that happen this time?
To your point, the higher for longer was really what happened with the, if you just look at that GFC period, if you could see a lot of these rate hikes and cuts are more of a sort of like a peak, not a flat top. So when you can look back in history, they didn't keep if you see those lines of recessions, they're not as deep as they were in the GFC, but that's really the first time you've seen in going back a long time to where it was really more of a flattening off. It was in the dot-com, but much more predominant in the leading up to the GFC, but we almost have that same flattening effect for the higher for longer now, only with much higher rates. So thank you for that. That is great information. And I think that we forget a lot of times, like you said, you better have a good reason if you don't think we're going to have some kind of a hard landing. We don't really do enough in looking back. And the other problem that we both know, and we've talked about it, is people don't dive into the data. They're listening to headline news, mainstream one-liners as they push that jobs report. But that's a big deal. And, when we're talking about the unemployment right now, I would be curious to know, in prior times of reporting this, 4.8 or 4.4 or whatever unemployment rate, were they considering the million Americans that we know that are of working age that aren't working? Mm-hmm. Did we have those same kind of numbers before?
We did.
And are they using the same metrics as they did before? Because we know that if they've been unemployed for a year, they're no longer even being accounted for. So I think, this is all, why people need to dive further into the data, and not to be doom and gloom or to be, saying that we're living in fear. The more that we're living in reality, that you need to be very mindful that you can't always believe what you're hearing in the news or from our officials. Let's talk a little bit about the threat of, because I'm concerned this go round with, the Fed has used this rate manipulation as sort of like its tool, its only tool in the toolbox as it pertains to two metrics, unemployment and CPI, inflation rate. And, when we look at the dollar, obviously, for those listening, some of you may know and have heard this before, but for quite some time, I think since 1944, the dollar, the U.S. dollar, we've been a global currency, the reserve currency for other countries. So just to kind of give you some kind of an idea of what I'm talking about here, when we go to school as Americans, we learn about the dollar, very little about financial literacy, but we do learn that the dollar, this is a nickel, a dime, a quarter, a dollar bill, 100, whatever, the denominations. And, but when you live in other countries, grow up in other countries, they will teach you two types of currency. You learn about your country's currency. Like if you're in China, you would learn about the yuan. And if you're, in China, just to finish this out, you would also learn about the dollar, the U.S. dollar, two currencies, right? So that you're becoming familiar with, because we've been the world reserve currency for 80 years, about plus or minus. Because the dollar is the reserve currency, a lot of it has to do with confidence. We have been able to build a confidence globally that we're a superpower. We are a market mover. The U.S. moves the whole global economy, and the dollar's strong as opposed to other currencies throughout the world. But I'm just kind of curious, Adam, in your thoughts, because in order for us, one of the reasons that the dollar has remained so strong is because we have had our interest rates higher than a lot of the emerging economies, the countries. We've been higher in our Fed rate, which has sort of, inflated the dollar, the value of it's appreciated. The dollar's appreciated. But when we drop below, when we have to push our interest rates lower in order to stimulate the economy, lower than other countries, it sort of devalues or depreciates the dollar. Any thought on that?
Yeah, several. So you're talking, about the dollar through the lens of foreign exchange. How is it performing
Correct.
versus other currencies? And
Yes.
It's very important to understand those dynamics. But I do want to get to, I think, what matters probably more to most people watching here, which is how about the dollar's value just in buying stuff, right? And I'll get to that in just a second. But yes, you're very right, and we as Americans are probably the only country out there that only thinks about one currency, right? It's a big luxury we have of having been the world's reserve currency. Is we're just not that impacted on a daily basis of what that exchange rate is. But a couple important things to note. So there's basically two pools of dollars. There are those dollars that are inside the U.S. and there are those dollars that are outside the U.S. And the dollars that are outside the U.S. dwarf the number of dollars that are inside the U.S. And a reason for that is what's called the euro-dollar market, where banks around the world make loans in their local currencies, but they also will make loans that are dollar denominated. And all of those dollar denominated loans impact demand for dollars around the world. And so if I live in a country that has one of the secondary currencies of the world, and I'm having to make loans that are denominated in dollars, if the dollar appreciates, it really kills me, right? Because it makes it harder for me to repay that dollar denominated debt in my local currency because the currency ratio to the dollar is dropping, right? So there's all sorts of things. As a result, there's all sorts of things that get impacted by the relative value of the dollar to the rest of the world. It is one of the reasons why we kind of have a series of advantages that other people don't have. One, we can print more dollars, and they have purchasing power across the rest of the world in a way that other currencies don't. So we have that advantage as a nation. But we also, if we reduce the value of the dollar, if the dollar value weakens versus other currencies, it's stimulative in a number of different ways. One, it makes it easier for other countries to repay their denominated debt. So it keeps the system a little bit more stable. It also makes our products and services cheaper versus others around the rest of the world, right? So a strengthening dollar or a weakening dollar, they both have pros and cons to them, right? A strengthening dollar, increases our purchasing power, so it makes imports cheaper for us, which we like. It makes puts the rest of the world in a little bit more pain. And if that gets dialed up too much, if the dollar gets too strong versus other currencies, you can start having solvency issues elsewhere in the world, and that can then lead to global slowdowns and things like that. So we've got to take all this stuff into consideration. But where I think the rubber meets the road for people on your question, Todd, is twofold. One is a really important driver of global investment. There's a number of them, but the big one is between us and Japan. It's the carry trade, right? It's where basically people are basically playing an arbitrage on the currencies. So they're borrowing the yen dollar carry trade, which has gone on for decades. Is you borrow dollars in yen because the interest rates are super low there. You then bring them over into the States. You use those to buy treasuries here in the States, which are yielding a lot more than what your Japanese loan is costing you, and you basically pocket the difference. And in fact, you can lever that up over time, and a lot of people have. And it's been a very consistent way to make money going forward. And there's been, just probably trillions of capital that's been placed on carry trade bets like that. If you start having big deviations with currencies, those carry trades can start blowing up. And that's actually what started happening, where Japan has been, until recently, they've been trying to actually let their currency appreciate versus the dollar. That has started to unwind the carry trade. And that's why in August, we had that really big downdraft day on August 5th that a lot of people remember. And then we've seen echoes of that since. So I'm probably getting a little bit too wonky here, but my point is you're very right, Todd, which is we have to kind of keep our eye on the relative valuation of the dollar versus other currencies from here. And I'll just say, look, if you're curious about where you think the dollar might head from here relative to other currencies, go watch any recent interview that's done with Brent Johnson. He tracks this very closely. He's coined the framework, the dollar milkshake theory, which has a lot of explanative value about certain currency changes and the impacts that they have. It's also why he says the dollar is even if for those rooting for it, the dollar is not going to lose its reserve currency status anytime soon for a lot of structural reasons that have to do with that wider euro dollar market that I talked about. But I think the more interesting part of your question was sort of like, okay, so for those of us that live in dollars, breathe in dollars, have to buy things with dollars, what should we be expecting going forward? Now, we've all just taken a pretty massive insult to our dollar holdings, right? If you look at the amount of inflation that we've had to absorb since the beginning of COVID, if you look at trueflation, which is an alternative way to measure inflation versus the government CPI calculation, where they look at a basket of, I think, like 1 million or more different goods and services, they estimate that the amount of inflation we've had to absorb since January of 2020 was somewhere between 25% and 30%. I hear from a lot of people, they think it might be higher than that, but let's take the trueflation data at face value. That means that a quarter or more of the purchasing power of our dollars has vaporized in the past 4 years. right? So when we're talking about, how it's harder and harder for the average American to make ends meet and whatnot going ahead, that's really the core of it, right? And getting back to your question about the central bank and about our issues on with our politics, is we have largely been living through an era of profligate monetary and fiscal policy. And that just means that our on the money side, we've been creating more money out of thin air. And on the fiscal side, we've been spending money we don't have and racking up debts at an ever increasing rate. And we've been, quote unquote, getting away with it as a country. But there's a piper that has to be paid. And at the end of the day, the unavoidable casualty of all that is the purchasing power of your currency. So, that is kind of, in a nutshell, why policy matters, right? Even though it's kind of wonky and whatnot, at the end of the day, what it does is it affects our ability to afford the lifestyles that we're aspiring to have. And it makes it harder and harder if those policies are continually depreciating the purchasing power of the currency that we transact in. And sadly, Todd, I don't see that changing anytime at all going forward. In fact, in many ways, I think the pace of that will probably continue to accelerate over the next decade at least.
When we're talking about Fed rates and things like that, I guess, more of what I'd refer to as a global economy and, the world's dependency. And by the way, I've had multiple interviews with Brent Johnson. I love Brent. He's a great guy. I do know that lately he has commented that he's been taking some heat on people saying that he's wrong on the dollar, and that we have the cleanest shirt in a dirty laundry pile. I think he puts it. But I guess the only thing that I really think about is these central bankers are really sort of, they're pulling the strings in a lot of ways, right? You had said that their purpose was to just help us out when capitalism was failing us, through certain times or another, when somebody needed money, or, the Fed had to step in and sort of inject or manipulate the market to build confidence again. But I just want to pull up this chart because I thought it was interesting. Global-rates.com here. And I don't know if you've seen this, but I just wanted to see, what has happened this month and really what other countries have sort of recently responded to our rate cut. And I thought it was interesting because number one here, we've got the United States on the 19th, cut rates by 50 basis points or 0.5%. Saudi Arabia also cut 0.5 basis point. South Africa cut 0.25 point. Brazil actually raised on the 18th, a day before, 0.25 point. And Russia raised their Fed rate a whole percentage point. And just looking at that, and I think of, I think of Russia, I think of Brazil, I think of South Africa, I think of the BRICS nation. And I think about what I had previously said, that in order for the dollar to stay strong in these other countries, or to be worthy, to appreciate, that their Fed rate has to be lower than ours. And I look at this, Russia's almost, you can see 4 times the rate that we are, and they're sort of leading the way with the BRICS, nation. What do you think of that? I mean, is there any relativeness to what I'm saying here or seeing here?
I would be a little cautious. I mean, I know where you're going, but I would be a little cautious here. One, Russia is in a somewhat unique situation right now, with the fact that it's embroiled in a war, and that it's got, basically the Western world embargoing it and whatnot. And remember, I was sort of talking about foreign exchange is a very dynamic market, and it's a game, right? Where so if one country especially an influential one like the US, weakens its currency intentionally through policy, a lot of the other ones are going to follow suit because in general, they're trying to stimulate, their export markets, right? So they probably won't stay there for very long. It's also a multifactorial game as well. And so I guess the question you have to ask yourself is, if it were US versus Russia or US versus Brazil, if they got involved in a currency war, who do you think would win? Right. And I think right now, most people would say, you know what, the U.S. probably would. And there's probably lots of weapons in our arsenal that we haven't even pulled out yet. If we wanted to get to the playing dirty stage. So then you have to ask yourself, okay, is the BRICS coalition as unified now to be able to act, as one to go up against the dollar? And are we seeing that begin to unfold in real time right now? I don't know. We certainly have, more increasing trade across those countries, for sure. The global economy is becoming less unipolar, and I think we'll continue to see that going forward. If you're interested in this topic, Michael Every is a great guy to listen to, and he's been saying that we're going to be seeing a much more mercantile and protectionist course being charted kind of by all countries going forward, where it's going to be less about globalization and moving towards a one world economy. And it's going to be much more about what's best for me and my people. And you'll see alliances, both trade alliances and economic alliances be created, but that they also might kind of fracture and reform, right? So the BRICS, I might be India and I might partner with China and Russia on certain things, but with the US on other certain things. So I would say right now it is early in the game to be putting too many of your chips on one team on that side right now. I don't think the status quo is hurtling towards an imminent change. And that being said, over time, will the U.S. will the global economy become more bifurcated or multifaceted with these different shifting traits? I actually think so. Will the U.S. dollar be diminished in its role as a reserve currency? I think so, but I think it's going to be the dominant player for a good long time. And just ask yourself, the Russian rates there were at 19% right now. If you had money that you were looking to keep safe right now, where would you choose to keep it if you were outside the U.S.? In a U.S. bank or in a Russian bank? I think almost everybody would be choosing a U.S. bank still at this stage. So, trust is a big factor in this story. And I don't think the world has shifted its trust enough yet to make the call that, like, there's a competing BRICS currency coming out, and the BRICS countries are gaining a leverage over the U.S. and its Western alliance members in a way that's going to totally disrupt the status quo. Could we be progressing there over the next decade plus? Yeah, maybe. But the reason why I'm sort of stating all this, Todd, is I've seen people over the years approach me in a panic and say, "Oh my gosh, I'm so afraid the dollar's going to become trash tomorrow. I just read about this new BRICS threat," and they'll go and they'll make really big allocation decisions in their portfolios based basically on the fear that this is going down now, and then years later that hasn't materialized, and they've been absolutely destroyed because they were wrong in their allocations, or at least they were so early as to be wrong. And that's a really important thing when you're, at the end of the day, I think most of your viewers are trying to do is just, keep as much of their wealth and grow it as much as possible between now and when they want to be enjoying the fruits of their labors. You got to know, where the puck is headed, but you also got to have a pretty good sense of when it's going to get there too.
Well, you can look at, we could take gold, for instance. It's going to be up, it's almost up 30% from the beginning of the year. And it's not because of retail buyers. This is because the central bank's buying as much gold as they possibly can, I think. So, I look at it and I say, I hear you. One thing I know for sure is these countries that are the BRICS nations, there's some pretty big players in the global economy. When India, China, Russia. You're talking about certainly some pretty big economies there. So it'll be interesting to see. Let's talk a little bit more about the stock market, because I know you're very familiar with that. A lot of people are when you're talking, I want to get back to the lack of volatility and the amount stocks are trading over earnings. The multiples are just so ridiculously high. A lot of people are saying that we are in for a massive correction. What do you think something like that would look like from a percentage basis? And let me, before you say that, if I talk about the housing market on my channel all the time, and people, a lot of people disagree. They think that prices are only going up, and there's a lot of different factors that come into play. Income, for instance, would have to significantly rise in order for these home prices to be sustainable with the cost of living. But I was talking with Harry Dent, and a lot of people think he's crazy, and I'm not a therapist or a clinician that can, say whether, someone is certifiable crazy or not. But I will say that what he says is that home prices can drop 50 to 80%. That would only take us back to 2019 prices. And the great financial crisis of 2008, we went back 5 years in pricing. So we went to 2003 prices. Home prices, if we went back 5 years, would mean, in depending on what market, anywhere from a 50 to 80% price correction. What would that look like in the stock market if we were to go back to a 5-year reset?
Yeah. So, I mean, a lot of the folks that I talk to looking on historical valuation metrics, right? So like people have probably heard about the Buffett ratio, right? Which is essentially a PE for the overall market. But it's market cap to GDP. And it's, I think we're up at about 200% again, which it's an extreme that we've rarely ever been at. And so, yeah, from the overwhelming consensus of folks that I speak to, that if we reverted to a truly fundamentals based market, we could see a correction of 50 to 80%. I think some would say down to about could be as low as about 1,800 on the S&P. Now we're at about 5,700 on that right now. I mean, it would be catastrophic. And to be super clear, I'm not calling for that. I don't want to make people think that I'm out there saying that's going to happen anytime soon. But it gives you a sense of the level of historic overvaluation that's in today's market.
That would be worse than the Great Depression.
I mean, it would be similar in terms of loss, of market value loss, of what we saw during the stock market crash of 1929.
But if you look at it, we don't make much in the country anymore. We don't know how to do things like we did back then. People rely, I mean, if you think about it, how many houses didn't even have electricity back then, right? I mean, they were utilizing outhouses to go to the bathroom, right? I mean, if you think about it, they had refrigerators that were really ice boxes, right? I mean, we have, through the years, become a society that really doesn't, last through adversity. We go into panic in a completely different way than we did back then, right? So I think something like that would just absolutely be catastrophic in nature. And by the way, I mean, what percentage of our lives are in this stock market now? I mean, we were talking about just unemployment back then, people losing jobs in the Great Depression. But think about what a catastrophic stock market collapse would be like in today's day. I mean, it would be really crazy.
Yeah, no, it would be nuclear.
It would be nuclear.
Yeah. So, let me try to delve into the spirit of what I think you're raising here, because I share your level of concerns, which is, in general, I think we've got many mispriced asset markets right now. The financial markets, the housing market, right? And those two together are basically the vast majority of American wealth, right? And one of the reasons that assets have gotten so detached from fundamentals is because of all of this intervention that we talked about earlier from our monetary authorities and our fiscal authorities here, right? And you can argue whether the policy decisions at the time were the right ones or the wrong ones to make, but I don't think you can argue that the outcome of those policy decisions were to push up asset prices, rewarding those who already owned assets, which are, in general, certainly with financial assets, 90% of all stocks are owned by the top 10% of households, right? So they're not, stocks aren't equally owned. When stocks go up, it disproportionately rewards the top 10%. Now, housing is more widely owned, but still, you got a third of the country that rents still. And when housing prices go up, that just punishes the renters, right? So, basically, the policy outcome has been to reward those who own the assets to the detriment of those who don't, right? They get stuck with the rise of cost of living, right? And so, we've just gotten so conditioned to this that as long as, we've got a toe in some of these assets, we're not complaining too much, right? We're happy to see our home prices go up. We're happy to see our 401ks go up if we're fortunate enough to have some good wealth in there. We've kind of just come to believe that this is just the way that it is, rather than what the truth is it's a deformation of the system. And you can only deform a system for so long before it has to try to get back to equilibrium. And I think that's what you're worried about. And that's what I'm worried about, is at some point here, there's going to be some corrective event or series of events that are going to bring things back more towards a market-based equilibrium. And there is going to be a lot of losses that have to be taken during that process. So yeah, I think that if the markets do correct, it could be really big. But even a 25-30% market correction is going to have a lot of shockwaves, right? Same thing in housing, right? I mean, we can't have a housing market that is valued at the rate the current housing market is, because it is so unaffordable to a record percentage of aspiring home buyers at this time. It literally is becoming a rich person's asset class now. And, either you own it and live in it, or you own it and you rent it out. And so you're in that camp, or you're in the camp of people who are just stuck as renters for life.
Or that own them and simply it's like a noose around their neck. It's just, a terrible, pain of affordability, they just can't keep their house up.
Yeah. And sadly, I think that's, if the status quo continues for long enough, we're going to lose all those people, right? They're just going to have to become forced sellers at some point, right? And we've talked about how not only is it just the high price of housing, but it's everything that becomes a knockoff effect of that, right? It's the property taxes, it's the insurance, it's just the cost of maintenance, right? That's skyrocketed. So yeah, we either are, becoming renter nation, right? Where we have an aristocracy that owns all the houses, and the rest of us are just paying our, tithes to them. Or, we get back to something that's more market-based, but to do that, it's going to require some real losses, in the system here, which, sadly, I'm kind of in favor of that part, because I'm always on the side of economic sustainability and economic opportunity. And I don't think having an artificially deformed market that rewards the wealthy at the expense of the lower classes is in anybody's long-term best interest.
Well put. Well, I know we are about a month away from learning who our next president will be. Obviously, not talking about sides. Do you have any feelings or predictions that you want to share? I mean, who you think will be the victor coming November 5th?
Yeah, I don't know. I'm not a political analyst. Sure, I have my opinions. I guess what I'll say is this. I feel like when times are good and people feel flush, they have the ability they have the luxury to be able to say, okay, philosophically, idealistically, what higher order, issues do I care about, and do I want to direct my votes based on them? But I think once you fall below a certain level of Maslow's hierarchy of needs, and you are just worried about, making rent and putting food on the table, all you can focus on is your pocketbook. And that question of, am I better off today than I was 4 years ago, I think becomes the dominant factor in casting your vote. Now, Kamala Harris has had a massive surge relative to where her party was before Biden was replaced, and certainly following the first Trump assassination attempt. So the race is, I think, still incredibly tight, and I can still see ways in which Harris could win here. And so I guess what I'm saying is I personally don't think I've seen enough evidence yet that enough of the population is feeling good enough on the economy that they're willing to vote on other factors besides how am I doing economically and how do I think I'm going to do going forward economically. And if that doesn't change between now and the election, I think that will probably determine the outcome. But we'll see. Because again, I'm not a political analyst, so I don't want to put a ton of weight on my prediction.
I feel the same way. Look, I'm right there with you. I think that two things that a current administration doesn't want, and I know that she's carving herself out as not being the current administration, but I know that what current administrations do not want in an election year, is a bad economy or high unemployment. And I think this is going to be an uphill battle. I think for the current administration, the best case scenario is that there's only 30 days plus or minus left before the ballots will be cast. So it's always a pleasure, my friend. I love talking with you, and we'll see. I certainly can't encourage people enough to cruise on over to Adam Taggart's Thoughtful Money, his channel, his links, follow him on his X, his Substack, everything below. Anything final thoughts you want to say that we didn't cover or that you want to just kind of recap?
I got a couple of final thoughts. Do you mind if I bang through them?
Yeah, no,
just because I think they're probably of high interest to your viewers. So one thing that might have caught viewers' surprise with the Fed cut interest rates by 50%, I think the narrative leading up to the Fed cutting has been, hey, that's going to be what rescues the housing market here, right? Which is that the Fed's going to start bringing interest rates down. That's going to bring mortgage rates down. That's going to allow people to start affording these current home prices here, and then we'll be off to the races, right? And what's interesting is that mortgage rates really didn't budge, right? In fact, I think they actually rose the day of the announcement. They're down a little bit since then, but not too much. And a lot of people have been scratching their heads about that. And I think the reason for that is, and I'd love to hear your thoughts on it too, Todd, but is that was largely already priced in. That when the Fed really began giving guidance back in July that it was highly likely going to start cutting in September, the market started bringing mortgage rates down. And so I think basically the cuts got front loaded, right? And so, again, I also think too that mortgage rates, if they do indeed start coming down from here, and I think they will, if the Fed continues to cut rates, which it's telling us it's going to, I don't think they're going to have the intended effect that many people do with the housing market, where, as I said earlier, they think, okay, mortgage rates are going to come down. That means prices will start going back up again. And if that were to happen, I mean, it would be like a magical free pass, right? There's the inverse relationship between home prices and mortgage rates. And we had super low mortgage rates, from the ZIRP era, and that pushed housing prices way up. And then we hiked interest rates at a more aggressive pace than we ever had. And housing prices didn't come down. In fact, they still went up a little bit more, right? And now people think, well, then as mortgage rates go down, then housing's... So basically, no matter what the mortgage rate does, housing's only going to go up, right? That's not how it works. And I think one of the things that has given us the sort of Frankensteinian market that we have is that transaction volume has collapsed so dramatically that a much higher percentage of transactions were being done by the wealthy. And that is what sort of artificially propped up housing prices to date. So if lower mortgage rates actually start increasing the ability of people to transact, it very well may start pulling prices down, which is against, I think what people's conventional expectations have been. But I'd be curious to hear your thoughts.
Well, you said a lot, actually, that I could speak on. Yes, the mortgage rates were baked into the Fed's decision to cut. I don't know the difference, the impact from a quarter of a point to, a half a point, but it was baked in. And I think what people have realized, and this is something that NAR has published, National Association of Realtors has published, that there was a study that in 2023, 82% of the home buyers during that period have remorse. And a lot of it is financial remorse. So I think that if you were kicked to the curb and you didn't buy, haven't bought yet because you've been outpriced because of affordability, I think that one of the things that you have are probably peers of yours now that will tell you that they made one of the largest mistakes they've ever made in their life by buying a home at the top of the market. Yeah, their interest rates were better, right? I mean, in a lot of cases. But what we have to be mindful of is that there's a lot more that goes into the cost of homeownership other than interest rates, mortgage rates. It's taxes, insurance, homeowner associations, condominium associations, other things, that repairs and maintenance. So when we were buying those houses in the highest exuberance of all time, where FOMO, fear of missing out, was sort of taking charge, and they were competing with investor buyers that were involved in all of that as well, cheap money, free money. What they didn't realize is by giving up their rights to home inspections, they're not going to do that this go round. So when they're looking at a house now that's on the market that is maybe a 40-year-old house that has outdated kitchens and bathrooms, HVAC systems, the cost to replace those now versus 4 years ago is way higher. And so I think that you're right. By dropping these interest rates, it's not going to do anything. If anything, it will increase the amount of inventory, because for the sellers that have been saying, well, nobody's going to buy my house because of a 7.5% or 8% interest rate, if they drop into the fives, they may be more inclined to sell now, thinking that the buyers will give them the profits that they were once hoping for. But I don't think that's going to work either. I think we're going to see more inventory hit the market. That will continue to weaken prices, just like you suggested. But the other thing that I want to talk about here is the interest rates. Builders and new home communities have been offering these 5.5% 30-year fixed rate mortgage rates for the last year and a half. So they've been taking the hit of the $50,000 or $70,000 it cost a builder to buy down those 30-year fixed rate mortgages, and it didn't work. And in fact, in October of 23, builders had the worst sales month on record, dating back decades. So I think that, we have to keep this thing in perspective. I think that if you're a consumer, a home buyer out there today, I'm hoping that you're much smarter than your fellow peers buying several years ago, and that you won't get involved in the exuberance. And I think the other thing that is really more important here is that they're smart enough not to put themselves in a debt trap that will cause them for life to just not be fun because of the amount of cost to have a roof over your head. So I'm hoping that we see some major correction for everyone. I think that we've just let this asset class, and I blame the Fed. I'm just going to say it. We should have raised rates when this asset class was running out of control. I think we should have raised rates, but I get it. I mean, now these local municipalities, Adam, can pick up this additional revenue called property taxes. So, Adam, I know that was probably more of a rant than you bargained for, but I was prepared for it.
No, and look, I agree with everything you said, my friend. All right, the only other thing I wanted to say too, and it's relevant to your point there about just hoping people don't get caught in debt traps, right? During corrective phases, both market corrections and economic recessions, there's a lot of destruction that goes on. And I think both you and I are just trying to hopefully decrease the percentage of viewers of this video that are going to get caught up in that destruction, right? one thing to be very cautious of is that's when debt really can become a stone cold killer, is when you enter, periods of recession. So yes, be very careful about overextending yourself. But at a high level too, I just want to note that, okay, so we've got a housing market that we think is dangerously overvalued. I think you didn't use those words, but I think you would probably agree with that. We have markets that I think we could make a pretty convincing argument are also dangerously overvalued here. At the same time, we have a consumer-driven economy where the consumer is getting visibly sicker, right? So we're seeing consumer spending becoming very anemic. We're seeing things like dining, which in times of distress, food is the fastest and easiest line item to control in a family budget. We're seeing dining out starting to really come down. Here, the Darden Restaurant CFO says that people all the way up to $200,000 worth of household income are seeing pullback, and of course pullback below that as well. We're seeing all sorts of consumer brands report disappointing guidance going ahead, citing consumer weakness. Renters, 21 million renter households spent over 30% of their income just on rent alone, rent and housing costs. That means nearly half of all renter households are distressed, right? So we're seeing an increasing percentage of the population basically beginning to experience, substantial conditions of distress and having to pull back, right? And that is going to have implications in the economy, right? We're at 70% consumer-driven GDP economy. Those consumers start cutting back. That's going to impact corporate profits. Profits are they're going to have to lay people off. People getting worried about losing their jobs then start cutting back on their spending, and you begin to get that vicious cycle that brings you into recession. Is that exactly what's going to happen from here? I don't know. On what timeline is that going to happen from here? I don't know. Although I do think that 2025 is definitely looking pretty sketchy from a year, both in terms of economic growth and earnings growth. And if these consumer trends continue as well, I just don't see how 2025 doesn't have some sort of material economic slowdown in it. All I'm saying is that these conditions that Todd and I are laying out here are conditions that say, hey, play defense. This is not a get super offensive macro environment right now. And if the markets do potentially run up into the end of the year here, as I mentioned that Jim Carson thinks might happen due to the rising volatility, I'm not saying don't play that if you want to, but I'm saying don't get trapped in the Roach Motel effect. If that turns out to be the last great hurrah, right, that sucks in the greatest fool right before the bear market comes in and pulls the rug out from everybody, don't put yourself in a position to be overly vulnerable to that. And that means if you're going to be long into the market, that's fine, but try to dance near the door, have some hedges in your portfolio in case things move faster than you expect. Don't extend yourself on margin. If you're looking to buy a home, don't just jump in with a FOMO as rates are coming down and buy a house that doesn't make sense for your budget. Don't depend on the house having to refinance the house. Don't depend on that being the way in which you're going to afford the house long term. This is a time to be defensive, and if the things that Todd and I think may happen do happen, those that are positioned in safety and have some dry capital to spend, not only will you be much better off, but you may be able to be in the catbird seat when the next recovery comes, and you could be buying things at really attractive valuations, and you can ride the appreciation wave from there. So what I'm just saying about all this is be careful. A lot of your viewers, I'm sure, are like mine, Todd, where they're 45 and older. They're trying to cross the finish line financially so that they can fund the life goals that they have. When you do that, you're playing for the rest of your life. You want to retire for the rest of your life. So don't put that stuff at risk by taking too many what I would consider to be stretch risks right now, given the current macro environment.
Great advice. I agree. Not the time to do that. And get your debt down. Yes, definitely. Buy that high interest debt down. Get rid of it. So thanks so much, Adam.
Oh, Todd, it is always a pleasure. Thanks so much for having me on your channel. I look forward to come back anytime. Thank you.
Sounds great. Thank you. Hey, thanks for making it to the end of the video. If you like the video, you can let Adam and myself know by hitting that thumbs up. And by the way, it does help heat up the algorithms to send it to more people. If you haven't already subscribed to Sachs Realty's YouTube channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. And now you can follow Sachs Realty. We're currently uploading to all major social media and audio platforms. I always enjoy reading your comments and questions. You can drop those below, and we'll see you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing.